With everything that's been going on in Iran and the Middle East, most of your investments are probably down right now, as that's certainly the case with the world ETF portfolio I share with my wife. We would actually be down further if the euro hadn't lost 3% in value against the dollar over the past month. As a result of the war and the Strait of Hormuz being effectively blocked by Iranian forces, oil prices have surged from around $67 to over $100 a barrel in just 10 days. That's the biggest weekly jump since the COVID pandemic. Needless to say, the headlines are genuinely looking scary, so it's perfectly understandable if you're concerned right now. But as hard as these periods are, and most of us probably wish this war never happened, let's try to take a step back and look at this rationally based on historical data. And of course, you'll also find out what I'm doing with my own investments right now. Let's get right into it, starting with a quick overview of what's going on. On the 28th of February, the US and Israel launched a coordinated military strike on Iran, and we are now on day 10 of that conflict. Iran has retaliated with missile and drone strikes, not just against Israel and US military bases in the region, but also against other Gulf states like Saudi Arabia, the UAE, or Qatar. As of today, there's no ceasefire and it's unclear when this war is going to end. Now, you're probably all aware of the news, so I don't want to waste any more of your time on this. Instead, let's focus on how this impacts our investments. Speaking of investments, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Ever since the war began, energy prices have been skyrocketing. More specifically, oil and gas. Iran controls the Strait of Hormuz, a narrow waterway through which roughly 20% of the world's oil supply passes every single day. As it stands, tanker traffic through the strait has come to a near standstill, as it's currently too risky for shipping companies and their insurance is becoming prohibitively expensive. As a result, crude oil prices jumped from around $67 to over $104 in only 10 days. That's a 56% increase. The last time we saw movements like this in oil prices was during the COVID pandemic in 2020. But the situation regarding gas may be even more relevant for Europe. That's because European natural gas stockpiles were already running low heading into this conflict. And Qatar, which supplies 1/5 of the world's liquid natural gas, sits right at the Strait of Hormuz. Since Europe heavily relies on it after moving away from Russian pipeline gas in 2022, this could cause a major problem. According to Goldman Sachs, European natural gas prices could more than double if flows are halted for 1 month, and more than triple if this lasts for more than 2 months. As a result, we European investors are facing a double hit. First, rising energy costs feeding into inflation as everything becomes more expensive. Transport, manufacturing, food, heating, and so on. And second, the stock market is currently repricing the risk of a prolonged conflict in the Middle East. Having said that, the stock market's reaction has still been surprisingly muted, with global indexes only dropping a few percentage points from the highs so far. How is that possible? Perhaps it's because markets have seen this or something similar before. Ben Carlson just published an interesting article about precisely this, looking at 40 years of data on oil prices and stock returns. Historically, what happened to stocks when oil prices rose and what happened when they fell. As hard as it may be to believe, average S&P 500 returns were actually higher when oil prices rose than when they fell in any given year. He also looked at what happened to stocks after oil jumped 5% or more 2 days in a row, which is exactly what happened recently. Most of the time, stocks were higher 1, 3, 6, as well as 12 months later. Obviously, none of this is guaranteed, and we're just looking at what happened on average in the past. I think a lot is going to depend on how long this conflict is going to last. If it lasts longer than anticipated, it could obviously impact stocks negatively. Now let's look at how markets have behaved during periods of war in the past. When the US invaded Iraq in 2003, there was a lot of uncertainty in the weeks before it started. But once the invasion began and the uncertainty became a known event, stocks started recovering, and 3 months later, the S&P 500 was up 13.6%. Something similar happened during other wars. US stocks dropped in the beginning and before the war started, but ultimately recovered and ended up performing well in most cases. According to the Swiss Finance Institute, markets tend to fall in a lead-up to war and immediately after surprise conflicts, but often rally once war begins. And even messy or prolonged wars can bring enough clarity to ease investor anxiety and stabilize markets. An analysis of 20 major geopolitical events dating back all the way to World War II showed stocks had fully recovered losses within an average of only 47 trading days, with an average max drawdown of just 5%. Of course, past performance does not predict future results, and every conflict is different. But the historical pattern is consistent enough that it may help someone that's freaking out right now calm down a bit. Which brings me to what my wife and I are doing with our investments right now. As I mentioned in the intro, we're currently down a bit, both on a monthly basis and now year to date as well. But when zooming out over the past 9 years, we have no reason to complain. Even in light of the current situation, I see no reason to change our long-term strategy. Our recurring investments into a global ETF continue running at the start of each month, and I buy additional shares whenever I get paid throughout the month since I'm self-employed. I actually think that moments like these reinforce the diversification benefits of investing globally compared to just being in a single market or sector. I have no idea which direction the market or oil prices are going to move over the coming weeks and months. And honestly, this part doesn't really matter to me. If we end up going lower, I'll appreciate that I get to buy shares of the best publicly listed companies from all across the world at a lower price. And if this ends up being the bottom, I'll be just as happy. None of this changes my long-term buy and hold investment strategy. This too shall pass. Now, of course, none of us know how this conflict will unfold. Maybe and hopefully the situation de-escalates in the coming weeks. Maybe it drags on longer than markets currently expect. And yes, if energy prices remain elevated for a long time, that could absolutely put pressure on the global economy. But this is exactly the moment where it helps to remember a few things as a long-term investor. Over the past 100 years, markets have gone through world wars, oil crises, terrorist attacks, financial crises, pandemics, and countless geopolitical conflicts. Global markets have continued to grow over the long term. No, not in a straight line and not without scary news headlines, but the long-term trend has been consistent. Because the truth is, events like these are completely outside our control. All we can control is how we respond to them. For us, that means sticking to our strategy, continuing to invest regularly, and not letting short-term uncertainty or emotions derail our plan. If the market drops further, we keep buying. If it recovers quickly, we keep buying. Either way, we stay invested, as trying to time the market has historically not worked out well on average. As difficult as these periods are, and most of us wish it never came to this war, I'm hoping that this video helped you a bit put the current situation into perspective. You can find my favorite brokers in Europe linked down below, which is a great way to support me if you'd like to. And if you haven't seen my detailed world ETF comparison video yet, make sure you watch it here afterwards. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.